There's a saying that I always keep in mind when it comes to investing. Be fearful when others are fearful, and be greedy when others are greedy. Just kidding. I'm sure you guys know how the actual saying goes, and this comes from Warren Buffett, who alone is worth now more than 150,000 average Americans. Well, over the last year, there's no doubt that fear has started to take over and has also raised the question, how are the richest people in the world continuing to invest in these markets? So in this episode, I'm going to be going over 3 of the most popular billionaires, and we're going to be talking about exactly what their step-by-step game plan is so it can motivate you, inspire you, or you could just flat out copy them as well in order to make sure that you guys stay ahead of the curve. So first of all, let's take a look at Kevin O'Leary. Most of you guys probably know who this is by the popular show Shark Tank, but his investments go way farther than that. Now, outside of the show, he owns his own investment fund called O-Shares ETF. So Kevin O'Leary has always been focused on investing in companies that have good fundamentals, growth potential, and primarily ones that also give out dividends over time. Now, normally when we're not in a bear market, we've actually heard Kevin O'Leary talking about investing into a bit more risky and newer sectors, like his big push into crypto over the last couple years. But it seems like so far in this recession and in this bear market, things are a bit different. I think what normally happens is when money gets tight, people tend to stop spending money on luxuries. So high-end clothing and shoes will see reduced spending, but sectors like pet food and children's items continue to stay stable. This is because you can't stop feeding your pet. I mean, you could if you're a terrible person, but you always have to make sure that generally kids, pets, those are taken care of. The reason I bring this up is because if we take a look at Kevin O'Leary's companies and what he's investing into, it turns out he's turning away from all the crazy crypto stuff and he's looking more towards the safer categories. By taking a look at his portfolio, we see McDonald's, Johnson & Johnson, Microsoft, and even Home Depot. And these, what they all have in common, very big companies, very safe, and all pay out a lot of big dividends. Now, I know Kevin O'Leary does a lot more outside of that, and he continues to invest on the show Shark Tank, which I would say is probably some of the most riskiest investments that you can make. But at the same time, he's a billionaire, so his strategy is going to be a little bit different. So let's take a look at someone else, and this is going to be George Soros. Now, George Soros certainly has his own interesting takes on the market, and one of those is his theory on reflexivity. Reflexivity. I mean, there's like 10 different ways I could say this. Y'all know what I mean. Basically, he believes that people base their investment decisions based on a feedback loop between expectations and market fundamentals. Without going too much into that, he's also had quite a bit of success running his investment management company called Soros Fund Management. Some of his other key success points were actually shorting the British pound and making over $1 billion in one day back in 1992, as well as managing the quantum fund and averaging 30% yearly returns for over 30 years. Now, the biggest difference between this billionaire and Kevin O'Leary is that George Soros is a little bit less focused on dividends and more focused on that short-term money gain. Now, as you guys know, recessions can be pretty unpredictable. We don't know how worse it can be. We don't know how long it can last. So even with this billionaire right here, he follows the investment principles of investing into safer options, but with a bit more higher growth potential. So some examples of this are Horizon Therapeutics, Amazon, Rivian, or even Bolero. Now, last but not least, we also have one of the OG legends, and this is Warren Buffett, who also has quite a bit of a different investment strategy compared to other investors. Now, it's pretty common that Warren Buffett has a preference for companies with solid fundamentals and investing for the long term. This principle here doesn't change because we're in a recession. The market could be crashing. We could be in another world war, but I feel like Warren Buffett is going to continue to stick through his principles. The one thing, though, that he does end up changing is the pace that he's investing at. Leading up to the potential recession last year, Warren Buffett was actually holding on to more cash and waiting for some more uncertainty in the market. And as he said, quote, "Bad news is an investor's best friend." Now, by the way, it's likely that there's still some safer alternatives to invest in during the recession, but it shows that Warren Buffett's strategies have been historically strong and worth following. Buffett looks for companies that are still undervalued, that have strong earning potential, that are transparent, and also he's a big fan of those dividends as well. It's shown that some of his investments that he's currently holding is Apple, American Express, Coca-Cola, Chevron, and Bank of America. So those are just a few examples of what some of the most popular billionaires are doing and some of their investing philosophy and principles. But I want to turn this full circle into what you should be doing right now. Look, guys, we're not billionaires, but look, we can always draw different types of lessons and different key things that they may be doing, but there are also things that we might also want to do a little bit different just because our risk tolerance is not going to be the same as if someone who has that much money. So first of all, you want to be sure to be dollar cost averaging. And in case you don't know what this is, it's basically just investing a fixed amount over a certain period of time to average out the price you buy in or sell off at. So let's say, for example, you buy 1 share of Apple today. Right now, at the time of filming this video, that would cost you about 180 bucks. But let's say tomorrow that price drops to $140. This means you could have bought in at a lower price, but instead with dollar cost averaging, you could take that same $180 and invest it over a 4-week span. So if today you buy a quarter share at $180 per share, then it goes to $140 next week, and then $160 a week after that, and maybe $190. It doesn't actually matter because you'll end up averaging out a price per share of about 165 bucks. Next, you also want to be aware of when investors are fearful or greedy, and you can access fear and greed indexes for both stocks and crypto and use that to help guide your investment decisions. Back to the quote that I shared earlier in this video, you want to be sure that you're always moving against the rest of the market when it comes to investing. This has been a general rule of thumb because it shows that when everyone is trying to buy in and they're greedy, usually it shows that the overall market is overbought and a correction is due. If the markets continue to stay fearful, it may not hurt to begin dollar cost averaging soon. For the third tip, you want to make sure you're investing into the long term, because if it's volatile short term, you're a newer trader and you're seeing your money go down. I know a lot of people can end up being just a bit salty when that happens, and if you are newer to the market, you might not have the emotional capacity to weather the storm. By going long, you'll have the long-term mindset, and if the markets are very volatile and it's shaky, you'll be able to make sure that you still come out profitable through a long-term horizon. Last but not least, you want to make sure you diversify your portfolio, because a lot of people make the mistake of overextending themselves into just a few stocks. If you end up having 1 or 2 stocks in your portfolio and one of the companies experience a big loss, that's going to affect a large portion of that portfolio. So be sure to diversify. There are ETFs, there are plenty of different stocks in different markets that you can check out. So remember, ladies and gents, recessions are where lifelong wealth is created, and by following these basic principles and even the simple things that billionaires do, I believe that you guys can find tremendous amount of value and continue to build your own wealth. So if you guys do want to get started, be sure to check out some of the other videos I have on this channel, and be sure to pick up some free stocks. Webull, Moomoo, they're giving out 20, 30 free stocks. It's a crazy amount. I use those apps. They've been great. And if you guys also want to score some free money, I mean, that's a free way you can do that. By the way, I also have a Patreon if you guys want to go ahead and join. If all this investing stuff is getting a bit overwhelming, or you just want to skip all of it and you want to join a great community and learn what I'm doing within the markets, I have a link for that link down below in the description. By the way, it sells out pretty quick. We only open a few limited positions every single month. So be sure to join if you guys can. And if you guys can't, I also have a waiting list as well.